Okay, welcome to video 2. Like I said, this is going to be a long problem. In video 2, we're going to look at Greenwald Company, and we're going to look at just 2018. Then we'll do a separate video for 2019. That way we can break it up just a little bit so you're not sitting here staring at the screen for quite so long. So let's start with the problem here. The Greenwald Company has a defined benefit pension plan. Pension information concerning the fiscal years 2018 and 19 are presented below, dollars and millions. The projected benefit obligation as of December 31st, 2017 totaled 1 million, or billion actually, but anyway, 1.85. Okay, so 1850. Let's just go with that. We're going to drop the millions, just ignore that, say 1850, make it easier. And then plan assets have a balance at fair value on January 1st, 2018 for 1400. Again, we know it's in millions, but just to make the problem easier, we're going to drop all those crazy zeros. Information provided by the pension plan actuary and pension fund trustee for 2018 are as follows. So it goes through each of the components there for 2018. Then additional information for 2019. So you can read through all those. We'll use each of the pieces as we need them. Then let's look. Required. Use the pension worksheet to solve the following. 1. Calculate pension expense, PBO, and plan assets for 2018 and 19. And then prepare the journal entries for 2018 and 19 to record the pension. Now, again, in this video, video 2, we're only going to look at 2018 just to keep it easy, and then we'll look at 19 when we start up in video 3. All right, so the easiest way, in my opinion, to attack sort of a pension problem is to simply go through the 3 components. The first thing we want to look at is, well, what impacts the projected benefit obligation. Then we're going to look at what impacts the plan assets. And then finally, we'll finish up the pension expense. And once we define all those pieces and properly place it in the worksheet, we'll have the perfect entry to go along with it. Okay? So let's start with the PBO. In video 1, we looked at the PBO and we found that 5 things impact the PBO. Service cost, interest cost, prior service cost adjustments, the actuarial gains and losses on PBO, and the benefits paid. Those were the 5 components of the projected benefit obligation. So where do we begin? Well, first, let's fill in our missing components. So beginning balances are important, especially in obligations and assets. So let's start there. Well, it tells us the projected obligation had a balance at December 31st, 2017 of 1850. Well, if that's the closing balance, then guess what? That becomes our beginning balance this year. Now, do make a note, projected benefit obligation, that is a liability to us. So as it being a liability, that's a credit account. So anytime we do a positive in here, that's a credit balance. If we do a negative in there, that means we're reducing our obligation. Therefore, that's a debit to the PBO. Cool thing is, we're not going to journal each of these individually. We'll actually journal it in one bulk, but we have to understand the direction of each of our accounts. Okay. Then it tells us also the plan assets had a fair value at the beginning of 1400. Again, I know they're in millions, but we're going to keep it simple, 1400. Now, plan assets, let's just add in there. Plan assets, those are assets. Therefore, plan assets would have debit balances. So a positive here would be a debit to the account. A negative would be reducing our plan assets, therefore it would be a credit. I find it easier just to think in terms of positive negatives, what's increasing and decreasing when we do these problems. That way we can add all those together and get one neat little amount that we have to either debit or credit to the account. Now, what's this pension asset liability? Well, some companies will hit PBO directly in plan assets. Some will do a summary account, pension asset liability. I like to carry this just to make sure that I'm in balance, because if we sum up these 5 here, we should be in balance, and that tells me my debits equal my credits at the end of the pension worksheet. So any time I use this pension asset liability, it's just so I can balance my equation quite nicely. Really, all this column is of course a debit is a positive because an asset's positive, and then here our liability would be a credit. So since the typical thing we would want here would be a debit, because we would want a pension asset. What does that mean? Well, when we have a pension asset, that means our plan assets exceed our PBO. In other words, we have plenty of assets to cover our projected obligation. Now, in this case, we do not have that situation. Notice our plan assets are 14, whereas our PBO is 1850. That means we're beginning this problem in sort of a underfunded situation. You're like, whoa, what does that mean? That means we're currently underfunded. So I want to put in there that we're underfunded by 450. That means that our plan assets are 450 less than our PBO. So if we were to report this on our balance sheet, we would actually report a liability there. Okay, so what is this column? This column here is simply the plan assets, 1400, minus the projected benefit obligation. And we'll always keep track of those changes throughout so that we can see what our final balance are. Now that we have our beginning balance in those two accounts, or three, really those two, and then what this means, we're ready to find the projected benefit obligation for 2018. Where do we start? Well, it says to start the 5 components. Number 1 was service costs. So let's read our problem here. What information do we have? Well, here it says prior service costs from plan amendment on January 2nd. Well, that is not the service cost for the current year. That's going to be a prior service cost adjustment. We're not there yet, so let's move on. Service cost for 2018 is $550. That's what we're looking for. Again, the service cost is because one additional year has passed. In other words, our employees have worked one more year, so therefore they've gained or acquired one more year of benefit in the future. So that costs money to us. So how does that impact our overall pension? Well, that increases our obligation. It's telling us, hey, we now owe them one more year. So we're going to credit the obligation because we owe more money. So notice it's a credit account, we owe more. Now, what offsets that? Well, this is a change here, so this means it's increasing our underfunded status. Notice assets haven't gone up any. Our obligation is going up by $550. That means we're increasing our liability position by $550. What's going to be offset? Well, if we're crediting the PBO, we need to debit the pension expense because the pension service cost is part of both the PBO and the pension expense. Okay, so anytime you do this worksheet, you should have a nice, neat in and out so that you can clearly show the debits and the credits that are going to take place. We're going to debit pension expense and we're going to credit the PBO. All right, so that takes care of the service cost. Now let's look at the interest cost. What goes there? Well, the interest cost, anytime again we have a prior projected benefit obligation, interest will accrue on that obligation. Now here we have to be careful. Typically speaking, we only have to take the beginning balance and multiply it by the rate of interest that we assume on our debt there. When we have a prior period adjustment, though, we have to be careful. Because when we have a prior service cost adjustment, so prior service cost from a planned amendment on January 2nd, not only do we have to take the interest on the $1,850, but we increased our debt for that. So we're going to add that to it. So here what we need to go ahead and do before is talk about this prior service adjustment. When we have that, that is taking or making a change to our pension formula. So instead of agreeing to pay 1.5% in the future, we've upped it to 1.7%. Now in this problem, it tells us that that's 550. Now I hate when we have a problem, well, hate's strong word. I dislike when we have a problem where two numbers are the same. This 550 and this 550 are two totally different things. This 550 is just the cost of having one more year of service from our employees. This 550 is because we altered the percent we're willing to pay our employees in the future. Okay? Now, it both have the same impact on our overall pension, but it is two different 550s in this problem. Now, where does this go? Well, the prior service cost goes right here, 550. It's not part of the pension. It's not part of the plan assets. It's actually prior service cost. This will be amortized over the remaining service period of our average service period of our employees, which is 10 years. So basically, since this happens on January 1st, beginning of the period, January 2nd, but the beginning of 2018, we're going to divide this 550 by 10, and at the end of each year, we'll amortize a piece of that. Now, why did I do that one first? Because since it's out of order. Well, the catch here, when we go to do our interest cost, we are going to take the 1850. So to do our interest costs, we're going to take the 1850 times 10%. But since we made this change, we now have to increase the interest by 550 because we're actually going to pay total interest on the sum of the two. So to find the interest cost, I'm just going to put the formula here, we need to take the 1850 plus the 550. And again, the 550 is this 550 because we have a prior service, It is not the service cost. Don't ever add the service cost. You always add any PSC. Now, if you only had it for a portion of the year, it's going to be for the full year. In other words, had this change been made before this year, we would not have 1850 in our beginning balance. Okay, we would actually have 1850 plus 550, which gives us $2,400. Okay, then we're going to multiply that 2,400 by the rate used by the actuary. So let's find that. It says, okay, discount rate used by the actuary on the PBO for 2018 is 10%. So we're going to multiply that by 0.10. So again, it's the 1850. Since we had a change, this 550 when we have a prior service would have been in effect last year had we done the change sooner. So this is retroactive. So that means our beginning balance here for interest purposes only would be 2,400. So when we do 2,400 times 10%, that's going to give us interest cost of 240. Interest cost also increases our PBO balance. Okay. Now, this column again, 0 minus 240. So this is creating greater liability for us. So we're further underfunded as we go here. Not looking too good. Now, what else is offset? Well, again, this is going to be a credit to the PBO. It's going to be a debit. Notice interest cost is part of our pension expense. So it's going to be a debit to our pension expense. Pension expense is a debit. All of these are, in theory, debit accounts. Even the losses here, if you do have gains, it would be a credit. So on this side of the worksheet, when you have a positive number, it's a debit. When you have a negative number, it's a credit. So that way you can easily distinguish when I need to debit or credit the account. All right, so hopefully so far that makes sense. We've gone over 3 of the components. The next thing is the actuarial gains or losses on the PBO. All right, so again, that comes when the actuary decides to change the service years. What do we think our employees will work on average? How many more years? If we have a change in the final salary, or if this year we had a change in the discount rate that they use to calculate the present value. None of that happens because here it tells us no changes in actuarial assumptions or estimates. So anytime we're dealing with each of these components, just always look to see what tells me that. We don't have to sit here and read every single bit of this up front because it's sort of confusing when you just go down the list. It's easier when we look at it as components of each piece. Okay, so actuarial gains or losses, it tells us they're 0. So we have no impact, which means we have no impact there, which means we have no impact on future gains or losses there. So we're just going to put a 0 there. So none of that is being impacted in this moment by gains or losses. Okay, and then the last thing we need to work on for PBO's benefits paid. Did we pay any benefits this period? So we scroll down through here, look. It's got to be somewhere. Typically we do have to if we've had any employees retire. There we go, we found it. Payments to retirees in 2018 were $410. So when we make a payment, it reduces the obligation. So anytime you make a payment, you're reducing the obligation that you have to your employees, So that's 410. So what does that mean over here? Well, when we're talking about benefits paid, where do they come from? It's not going to impact anything here. When we make a payment, it comes out of your plan assets. So your plan assets are also going to go down. You're like, wait a minute, both are negative. That's fine. Because notice, a positive and a plan asset's a debit. So this means we're crediting the plan asset. Here we've got a credit would be a positive, so that means we're debiting the PBO. So it's perfectly fine. We're debiting the PBO and we're debiting the plan assets. Benefits paid would not impact the pension expense. Notice it's not part of pension expense. We're not paying it with cash. We would actually pay benefits out of plan assets. So we do not want to hit cash here. Has nothing to do with prior service costs or gains or losses. And notice, what's the change here? Well, 0. If there's 0 change here, that means there's going to be 0 change back through here, or an up and a down, but typically it's a 0. Okay? All right. So now, if we really wanted to, we could go ahead and find our balance here. So how does that add up? Well, notice this is the journal entry. Another way to look at this, if you wanted to, this is the change in the account. So how much did we change the PBO by? Well, we had a beginning balance, and here are all of these items are going to change it. So I'm going to make those red just for a moment. I'm going to change it back in a second. So we're going to add up those 5 components, and when you do that, you're going to end up with a $930 credit. Again, it's in millions, but let's just keep it simple, $930 credit. That means we're increasing the balance of our PBO by $930. We have $1,850 credit. We're going to credit the PBO for $930. Therefore, our ending balance that we're going to end up with in our PBO is $2,780. Now we found the balance in our PBO. Let's continue on and finish up with our plan assets. Before we do that, let me just put this back to its normal color. We don't need them red. I just was sort of trying to give you an example of what we were adding up there. All right, so plan assets is the next component we want to find. Again, we said there's four items in the plan assets. There's the benefits paid, there's expected return on the plan assets, there's the actual return on the plan assets, and there's contributions. Those are the 4 items that go into plan assets. We've already got our benefits paid because they also impact the PBO. That's the overlapping item. So let's talk about the expected return. So let's go up here and look in 2018 and find what was our expected returns. So we've already talked about the service cost and the prior adjustment. Talked about the discount and the payment. We've already discussed this. So let's go down. Do we have anywhere where it says an expected return? Oh, there it is. Expected long-term rate of return on plan assets. Again, we have to get this from the actuary or the plan trustee. That tells us that our expected rate of return is 12%. So how do we calculate it? Well, anytime you do that, you take your beginning balance, because that's what you had to start with, and you multiply it by what your expected return is. So in this case, it's going to be 1,400 times 0.12, and when we do that, we get 168. Now, that 168 is going to increase. For example, again, if you put cash in a savings account, you get 3%. Do you have more or less cash when you come to the end of the year if you don't touch it? Well, you're going to have more. You're getting a return. So our actual return is going to be 168. That's taking up our balance in the PBO. Okay. Now, what offsets that? Well, again, plan assets minus PBO gives us a change here. So we're starting to correct that underfunded status. Notice now we're sort of saying, hey, wait, we were underfunded. Now we're sort of correcting that because we think we'll get 168 in actual return here. So that's a good thing. All right. Now, what else do we need to calculate? Well, when we talk about the change in plan or expected return, notice that's also part of the pension expense. So we're going to go over here. Well, what does that do to pension expense? Well, it actually reduces it because you're making money off of the assets that you've got in the plan. It reduces or helps offset your pension expense. So it's going to reduce our pension expense for the period. It's one of the components. So notice we've got this. We're going to credit the expense because we're reducing it, and we're going to debit the plan asset. That's a good thing. We're actually helping to offset some of the expenses through the use of our assets. Now, anytime you have an expected return, you also have an actual return. Now, that can sort of throw us a little bit. So let's talk about the actual return here. Go and find it. What did we actually make on our assets? Now, sometimes it gives it in the form of a percentage. Sometimes they'll just tell us the actual return. 2018 actual return on plan assets, 120. Okay, now that's not great because we expected it to be 168. We only got 120. So did we get more or less? Well, we have 48 less in return than we thought. So how are we going to fix the return on our books? Well, we put the full here. We don't want to go here and put 120 because that would make it look like, ooh, we made 288. That's awesome. That's way high. No, we didn't. We only made 120. So we're going to take this and we're going to say, hey, we were under. We expected too much in return. We actually came in less. So negative 48 minus 0, that means we're actually not as well off as we thought. So we're undoing some of that correction to the underfunded. Now, again, that's not part of the pension expense. That's actually part of the gain or loss. Okay. So we're going to credit our plan assets. We need to debit our loss. So that's going to be a positive debit to our losses there. Again, the cool thing is we get to sort of spread that across, so we're okay. We'll put that into our accumulated other comprehensive income. So it doesn't actually hit our income statement yet because they're not actual losses, because it can come back. So we made 120 this year. we make more than expected next year. It all sort of balances out over the life, but we have to make sure that at the end of the day, those planned assets do come up to meet our obligation in the future. Okay. Again, it doesn't impact anything else. We've got our debit and our credit here, so we're good to go. All right, moving on. The last thing is contributions. Contributions are when the company takes money out of their normal assets, cash, and moves them into the plan assets. So, did we make any contributions? So let's pull this up just a little bit so that we can get this whole thing in. There we go. Let's go back to our information. In 2018, do we see anywhere where this company contributed more to the plan assets? Absolutely, most always you will. 2018 contributions were $570. Well, when the company puts a contribution in, what happens to plan assets? They go up. Well, that's a good thing. We're going to debit our plan assets for $570. That means over here, again, we're working to decrease this underfunded position. So we're going to add in there to the asset $570. Then what else has to happen? Well, cash has to go out because we're moving cash. And this is the reason this cash column's here, to show the offset. We're going to credit our cash and debit our plan assets. Okay, that's going to help fix this underfunded. Won't completely fix it, but it'll help fix it somewhat. All right. That defines all the plan assets. So let's do the same thing. Let's add up these four components here. So if we add up the four components, negative 410, 168, negative 48, and 570, what we'll see is we're going to increase our overall plan assets by 280. That is a debit because we're increasing those. Okay. Now, if we increase them by 280, notice we have 14. We're going to increase by 280. That brings our ending balance in our plan assets to 1680. Okay. Now, are we increasing or decreasing our actual under or overfunded? Well, we'll talk about that here in just a little bit. But right now, the difference between the two would be 1100. You tell me, under or over. Okay. Now, the last thing we have to do to finish up this pension problem really is to find the remaining components of the pension expense. We've already defined a portion of it. Remember, we said pension expense is created by 5 different items. The service cost, and again, those were the actual, let me put a little asterisk here so you'll remember. That was the service cost, the interest cost, the expected return, and the amortization of the PSC. And the last component is going to be the amortization of the gain or loss, which we haven't talked about. So that's the 5th component of our pension expense. Okay? Now, did we amortize any PSC? Well, we had no beginning balance in the PSC. How do we know that? Well, let's just see. They didn't tell us anywhere. It doesn't say that the prior PSC balance was XYZ. It doesn't say we have any amortization from a prior year. So we know we didn't have anything in the prior year, but we did this year add 550 at the beginning of the year. So like all things, when we go to do adjusting entries, we have to adjust to amortize that 550. And we amortize it over a 10-year period. So at the end of 2018, we'd take that 550 because we would have assumed it would have started at the beginning, divided by 10. So for each year on this pension, we need to amortize $55, again in millions, but $55 of that PSC. Okay, so each year, 55. Now what does that do? Well, prior service cost is an expense that we're deferring. So as we amortize it, we're actually going to increase our pension expense each year for 10 years for $55 there. Okay, what does that offset? Well, we added the 55 here. Each time we take it, we're actually going to reduce the balance in our PSC. So we put 550 in at the beginning. Now we're starting to amortize, which means just allocate that over its life by 55. So at the end of each year, we'll drop that balance to 55. At the end of 10 years, we will have 0 prior service cost, assuming no future changes in the account. Okay, nothing else was impacted, so a 0 across the board. Are we in balance? Well, absolutely. Debit, pension expense, credit, PSC, we're in balance. All right, and then the last thing that impacts the pension expense is the amortization of any prior gain or loss. Now, to do this, we have to do what we call the corridor test. The corridor test tells us to take the net gain or loss at the beginning of the year in accumulated OCI. So what was our beginning balance in accumulated OCI? Well, let's go up here. Somewhere it's going to tell us what our beginning balance is. There we go. We had a beginning balance in the accumulated OCI on January 1st of 245. Now, we're not going to recognize all that 245 at once, okay? But that is our beginning balance there. So anytime you're doing the corridor test, first start with the beginning balance. Then the next thing you take is the 10% of the larger PBO or plan assets. So again, this is strictly the beginning balance, what you had in there before any changes this year. So let's go up. We had 1850 in the PBO and 1400 in the plan assets. So which is larger? Well, the PBO is larger, so we're going to take 10% of that. That would give us 185. So always take the 10% of the larger balance, so we're going to get 185. Now, ask yourself, is our gain or loss greater than 185? If the answer is yes, we get to subtract the two. That's the amortizable amount of the accumulated OCI at this point, those gains or losses. And so we take 245 minus the 185, excuse me, and that gives me 60. That's the amount we're allowed to amortize at this point in time. That does change each year based on balances. Okay, so then we take that 60 and we divide it by the number of service life left. So up here it tells us net gains and losses are amortized for 10 years in 2018 and 19. So for both of these years, if we're allowed to amortize any, we amortize it over 10 years. So we take the amortizable amount, we divide it by the estimated service life that we can amortize it over, and that tells us what our current year's amortization is. So again, for the corridor test, you take the net gain or loss at the beginning of the year. You take the 10% of the larger PBO or plan assets, which in this case was the PBO, so 10% of the 1850 was 185. If and only if the net gain or the balance there is higher than the 10%, you get an amortizable amount. You divide that amount by 10, and then you come up with the 6, okay? But this must be larger. What does that mean? Well, just really quick, if this were 100, this would be 0 because you're not allowed to amortize anything, okay? It has to be greater than the balance. So at 245, it is 60 greater than the 10% of the larger. That allows us to amortize 60 over 10 years or 6. That does change every single period, so you always have to check your corridor test before doing your gain or loss amortization. Okay, some problems just give you the amount. Sometimes they tell you the balance and you have to figure it out. So always remember, if it doesn't tell you the actual amortization amount, if you have a balance there, which it did, it said, hey, your net a gain or loss, it could be a loss position, in AOCI is 245. That tells me, hey, either they have to give me the amortization number of 6 or I'm going to have to calculate it on my own. Okay, and that's the corridor test. All right, so we come up with 6. Now, what is that going to do? Well, if it's a gain that we're amortizing, gains offset expenses, so therefore it's going to be a credit to the expense. It's actually going to reduce it. If we were amortizing a loss increases our overall expenses, right? I know a loss isn't an expense, but it reduces income. So an expense reduces income, a loss reduces income. So that goes into our expense and helps us, or increases the expense. If we have a gain that we're amortizing, it actually offsets the expense, so it's going to reduce the expense that we have to record that year. Since this is a gain, it would be negative. Also, we know that because a gain would have a credit balance. Well, if a gain has a credit balance and we need to amortize it, we need to actually debit, okay, and we're going to put a positive here because we're debiting the account. We need to debit the gain account to offset that credit. So if we have to have a debit here, by nature, we're crediting over here in the expense. Now, I know that's a lot of moving pieces, but we've talked about all the components now. So we should be able to add everything up in our worksheet here and come up with a nice, neat journal entry. So if we take the 550, the 240 minus 168, the 55 minus the 6, we should get 671 as a debit to pension expense. So that's going to be a total debit there to pension expense. Then our cash, we've got a negative 570. Well, cash is a debit, so by having a negative cash, that means we're crediting our cash account. Our prior service cost, that is an expense that we've deferred, so that 550 is a debit balance that we added. Then we credit for 55, so what's the net? Well, we're going to have a net debit to this account for 495, and that's a debit. Gains or losses, again, losses are the debits here. So as we increase, we're increasing the loss. As we decrease, we're offsetting the gain. So this year we did a 48 actual return difference there. And then we have a 6. So that brings us to a total of 54. And again, that 54 in gains or losses is going to be a net debit position. Now the cool thing is when we do this, we actually have to record the amortization separately. These two are creating balances in the gain or loss. These two are removing or reducing, amortizing the balances. So when we go to journal this, we will keep these two separate from the following up here. And I'll show you that when we actually do the journal. But the net impact would be a debit. And then the last thing we need to look at, we already know here, but the net of this, 280 minus 930, is a difference of, so again, $280 here in plan assets minus 930 would give us a negative, and it would be a negative 650. Now, that is a net credit position. Okay, we're not going to credit this account, but we credit the PBO for 930 and the plan assets are a debit of 280, net negative. Does that balance this out? So if we were to add all our debits and credits here, we would come up with a true net position of 0. So our debits equal our credits. So let's finish out this worksheet and then do our journal entry. Now, the next thing is important is we have to be able to know what our accumulated OCI balances are in the future. So here, to start the period, we had absolutely nothing in accumulated OCI. We're adding 495 to it, so we're going to carry 495 balance in prior service cost. So it's going to be a 495 there. That is a debit. So if you want to put the debit there, you can, because we're not going to add anything to that. We're going to add them up here in a minute, but we're not going to add anything to that. What was our beginning balance in the PSC? Well, we've already done PSC. What was our beginning balance in the gain or loss? Well, remember it told us we had a net gain of 245. So a gain is a credit. So I'm going to put negative 245 because that's a gain. It's a credit position. We are reducing that by the 54. So the 245 netted with the 54 gives us an ending credit balance of 191. So I'm going to say, hey, that's a 191 credit. Now, it's not negative, I know, but the way the worksheet works, if you'll do debits and credits the way I'm doing them here, it helps us. And then we had a beginning underfunded position of 450. Well, how do I know that? It's up here. It tells me we had an underfunded of 450. We have a greater underfunded position. So at the end of the period, we're actually going to be a net liability. We are underfunded, way underfunded at this point. Okay. And again, how do we check that? It's the difference between those two. Now that's just the pension asset liability. So go over here. Our accumulated OCI at the end is going to be a lovely 304. And that is a net debit balance because the expense, the PSC, is greater than the accumulated. Now you have fully done a pension worksheet. You are fully prepared to go in and do your entry. So let's do the entry. I know we're getting long here. These are long problems. That's the reason we're breaking them into 3 videos to give you a break. So I'm going to pull this down like this, and then I am going to split my screen again. Why is that important? Well, we need to go and do our journal entry. Okay. So go down here. We have our journal entry on page 4 here. We're in December of 2018. I'm going to do my pension entry. First thing we're going to do is pension expense. Our pension expense is going to be debited for 671. We've already figured that up. Let me fix my formatting. It drives me a little crazy there. So there we go. We got our pension expense. Now what else do we need to do? Well, remember when I said we do this, this is going to be a credit to cash. I like to do my debits first, so we'll come back to that. Let's go over here. When we do this, we're going to hit these separate from these two. Always, you're going to journal these items separately. You could do a bulk, but there are 2 things. What's the 550? Well, the 550 is creating prior service cost. So since we're creating the PSC, we need to go in and say, hey, this is creating prior service cost. It is going to be a debit of 550. On top of that, we're amortizing it down by 55, so we are going to do a credit at some point of 55. But again, let's come back to our credits. Same way with the gain or loss. Here, a debit is a loss position, so we're adding to our loss position that to be amortized in the future, 48. So for that item, we're going to hit loss. And again, it's not going to our income statement yet. It goes to other OCI. It will eventually become part of pension expense, but only when we're allowed to amortize it. Okay. Now, talk about the 6. We are amortizing some of a prior gain. Well, what did we say we're doing there? Well, when we amortize a gain, we actually have to debit the gain. So we're going to go in and we're going to debit the amortization of gains or losses. And again, it is hitting OCI when we do that. It's reducing the balance there. And we're going to hit that for 6. Oops, I forgot to put the 48 in there, so let's get the 48 in there. All right, any more debits? Well, there's one more debit. Now remember, we're not going to journalize this column. This just tells us that we're in balance. Go over here. The 930 for the PBO is a credit, so we're going to credit the account there. The 280 is a plan asset going up, so we're going to debit the plan assets. So go over here and hit plan assets for 280. Now, how are we going to close this out? Well, let's close it out with the credits. We talked about the credits. One was cash. So go back. We needed a credit of 570 to cash. Then what do we need to do? Well, then we said we needed to credit this 55. Right there. Notice it's a credit. We got to find all our credits. That 55. We need to hit the amortization of prior service costs. And again, that's going to hit OCI. Does not hit income. It's going to be OCI because we're reducing that balance, and plus we're already including it in income over here when we hit the PSC, or excuse me, yeah, the pension expense there, sorry. So we're going to go in and do that. So that would be 55 for the amortization of the PSC. All right, very good. Now, we've got the cash, we've got that, we're not in balance yet. What are we missing? Well, there was one more credit on our sheet because remember, this is a net credit position. So we need to credit our PBO, projected obligation here. So you can either do PBO or projected benefit obligation. Might help if I spelled it correctly. PBO. And we're going to hit that for what it tells us there, the 930. Now, I know that's a big entry. You can actually break it up into several smaller entries if you want to, but that's the net impact of these entries. Okay. So hopefully that helps clarify how to find each of the components of the PBO, the plan assets, and the pension expense. Once you're done, you journal all of your components and you are good to go. Okay. All right, so that concludes video 2. It's long enough, 37 minutes. Video 3, we will talk about 2019. Hopefully it'll go much quicker now that we've went through this year. We can start off on the right foot and get 2019 complete.